Good morning, everybody. Thank you for coming this morning. Our presenter is Han Shia from UT Dallas. He's going to be telling us about pump and dump through Mediatone, the role of cross-block holders in corporate litigation. And just as a quick reminder, if you could put your questions in the chat box, and then I will relay them on to Han. So he's just got to just listen for one voice. So thank you again for coming. And Han, the floor is yours. You've got 75 minutes.
Okay, perfect. Thank you so much, Kevin, for the introduction. And also, thank you for the opportunity to present this paper and also for everyone who's joining this morning. This is joint work with Jack from University of Georgia and Yabo from UT Dallas. And Yabo is one of our PhD students, and she will be on the market this year. Okay. All right. So let me start by talking a little bit about the setting of our paper. Okay, so our paper is based on the setting of corporate litigation. And corporate litigation is usually considered as a negative corporate events by the market. Now, indeed, if we look at over 8,000 corporate lawsuits in our sample, we see that the average CAR of the defendant firm is about -4% in the 30 days around the litigation announcement. Now, during this period, there are papers showing that many investors who holds the defendant's shares just exit and capitalize their losses. But the story might be a little bit different for block holders who usually have a large proportion of the firm. This is because in this case, they will be constrained by the illiquidity of large sales, so they cannot simply quickly unload their large blocks when everyone else is also selling. So now the question is that in this case, what do they do? Is there anything these block holders can do to sort of strategically support the defendant firm stock price so that they can have more time before they successfully exit? Okay. Now, before we formally answer this question, I would like to show you a few anecdotal examples, and hopefully they will summarize the key intuition of the paper. All right. So the first example that I would like to talk about is the Facebook Cambridge data scandal. Okay, that happened in early 2018. All right. So Facebook users filed a lawsuit against the company for violating the data privacy. And not surprisingly, this data scandal attracted a lot of attention from different media companies, including Washington Post and New York Post. Now, the difference between these two newspapers is that at the time this scandal happened, New York Post shared a large block holder with Facebook, but Washington Post did not. Okay. Now, on March the 21st, that's one day after the scandal happening, Washington Post, they issued 4 articles. And these articles, I can tell you, are really, really negative. And we can probably tell this by looking at their titles like, Facebook's terrible, horrible, no good 24 hours, or yes, we should be outraged about Facebook. Now, well, on the same day, New York Post also issued 4 articles, but with more benign narratives. Okay, so what those articles did was essentially portray this incident from the company's point of view and cited the comments from their employees. Here are some examples. We thought we were doing something that was really normal, and we were assured that everything would be perfectly legal. And the company made a mistake, and now we need to step up and fix it. Now, what's interesting is that in the 2 quarters following this scandal, the block holder between New York Post and Facebook, liquidated over 1 million Facebook shares. Okay. All right. So now here's another one. Chipotle. Okay. So Chipotle was sued by their customers after they became ill with the E. coli bacteria. Okay. Now, again, 2 newspapers are covering this. One is New York Times and one is Wall Street Journal. And Wall Street Journal was sharing a large block holder with Chipotle at the time, but New York Post was not. Okay. Now, when New York Post was describing this incident, they really went above and beyond, and they recollected actually 6 other related incidents of Chipotle over the past few months. And they cited lawyers saying that, you know what, I can't think of any restaurants who's ever reported this many outbreaks. But Wall Street Journal is different. Okay. Several days after the incident, Wall Street Journal published an article with the following opening. Okay, so they say that Chipotle executives are confident that they can rebound from this recent outbreaks, and they actually start a new marketing campaign next month. Now, again, interesting, in the 2 quarters after this incident, this blockholder between Wall Street Journal and Chipotle liquidated over 5% with Chipotle's outstanding shares. All right. So what do these examples tell us? They have a common thing. Okay. Institutions often own blocks of media and industry firms. And when the industry firm becomes a defendant of the corporate litigation, what the institutions can do is to influence the media companies that they hold at the same time so that they can provide more favorable coverage of the litigation event. Okay. Now, why do they do that? They do that because they can potentially pump up the general sentiment of the investors and mitigate the negative stock price impact, and therefore allow themselves more time to exit their large positions at a higher price. And this is what we call a de facto pump and dump strategy. And this is what we're going to do in this paper. In this paper, we're going to use a large sample to document this strategy. Okay, we will further look at how this strategy impacts the stock price and how institutions can potentially benefit from it. Okay, I think this might be a good time for me to stop for any questions, if any.
So far, so good, Han. You can.
Okay. Okay, perfect.
I have I'm JP Gomez from IAB School. Just
Hi,
a very
JP.
simple, naive question. Is this legal? I mean, can this guy so bluntly just pump and then dump?
Well, so here, this is why we call this strategy as a de facto pump and dump. So essentially, but at least in our opinion, so there's nothing wrong the institutions or the media was doing. So all they do is just to provide more favorable coverage of the litigation event, and this is particularly possible given that media and contents are usually more subjective. And they are, different from other agents' information like ratings or, analyst recommendations, which are usually based on hard information. So here, what we're talking about is soft information. So at least in our opinion, there's nothing wrong or therefore nothing illegal that they're doing. Yes.
Vikas has a question as well.
Yes.
Yeah. So Han, this is very interesting, of course.
Hi, Vikas.
Yeah, hi. I was my question was it's actually more complicated, right? Because Facebook and Chipotle have competitors as well, and they have also skin in this game. So it becomes a little bit more complicated because then there would be institutions who are holding positions in those, and so there would be media companies that are related to those block holders. So did you guys look at this whole sort of network, so to speak?
That's a really good comment. And to be honest, we haven't thought about that. But based on my understanding of your comments is that if Facebook has a competitor and if the institution is also holding the competitor, that might change their incentives and therefore strategies.
Right.
We haven't looked at this in this version, but we're very happy to. So we can tease out we can look more in detail. Yeah, we have the data to look at all the holdings of the institutions and see in a more competitive environment if that changes our results. So far, just based on how I think about it, it's like you said, it's probably more complicated and we don't have a clear prediction at this moment.
So just to go back to your example, right?
Yeah.
So if you just take any of the 2 examples that you gave,
right.
Right. So in this example, like New York Times was not holding Chipotle, right? And I mean, New
Correct.
York Times was not block held by any of the Chipotle institutional investors.
Mhm.
My question is, yeah, it's possible that Chipotle's competitor is actually having block holding New York Times, in which case it becomes like a war between the competitors. And
So
that
so when you say Chipotle's competitor is holding New York Times, you mean you didn't mean the institution, another institution is holding New York Times. You mean another firm in the same industry of Chipotle.
no. So okay, it's more complicated. Okay.
Okay.
What I'm thinking is, so let's say Chipotle has a competitor. Okay, let's
Okay.
call it McDonald's. Okay, I don't know.
Okay.
But now McDonald's and New York Times has block
Gotcha.
holding by another institution. Now,
Gotcha.
then McDonald's might influence that block holder and say, hey, you need to basically make this story big. So who should New York Times listen to? Should they listen to, so you see my point, like what I'm,
Yeah, I do see your point.
yeah. So I think that's what makes this whole thing a little bit complicated.
Yeah. So in that case, so I think it's really interesting if we move that example to Wall Street Journal. So in this case, Chipotle has a competitor, McDonald's, and this originally cross-holder between Wall Street Journal and Chipotle may inflates the tone in a less extent because McDonald's does not want to do that. In other words, we probably will have the cross-sectional variation based on the other holdings of the institutions. Yeah, I agree with that. That would be interesting to look at. Yeah, thank you.
Thank you.
Han, we have a question from Paul Irvine.
Thank
Yes,
you.
sir.
Hi, Han.
Hi, Paul.
Jack, geez. Okay, I think Beaks's comment is really salient here. Let's just take an example. So Bezos owns the Washington Post.
Mm-hmm.
So how's a 5% block holder going to get the Washington Post to change their tone about a company?
I'm sorry, I didn't. Your voice was breaking a little bit. Could you?
I beg your pardon. So right now, Jeff Bezos from Amazon owns the Washington Post.
Okay.
So notwithstanding the network problems that are associated with who Amazon likes and who Amazon doesn't like, how does a 5% block holder influence the coverage in the Washington Post? What's the mechanism that you guys are proposing here? That's all. Thanks.
Okay. So the mechanism we're proposing is that, well, so first of all, as I will talk a little bit more when we talk about how we design the test, how much this institution is holding this defendant firm.
Yeah, but that's not a mechanism.
It's no. So
measure.
that's not a mechanism. But I was just saying that yes, that is considered exogenous in our setting, and I will tell you why we consider that as exogenous. So given that 5% is preset before the litigation, then we're saying that, hey, look, if Chipotle is going through some negative events, then the Wall Street Journal, which was held by another institution, will have the incentive to pump up the litigation event, to pump up the sentiment of investors, because that would be favorable for the institutions the holding of the defendant.
Okay.
So essentially, that's the mechanism.
Let's go back. Washington Post is owned by Bezos. Why do they care about any other block holder that's not Jeff Bezos? Or only do this for companies that Jeff Bezos also approves of?
So I think you brings up a question that's related to Vegas. So I think what we can do.
It is. Yeah.
So what we can do is that, in addition to look at the competitors of Chipotle. Okay, like Vegas suggested, we can also look at what are the institutions, the full profile of the profiles of the institutions that are holding Wall Street Journal. And some of them, Amazon is, think about Amazon. Amazon is one of the block holders, but there are other block holders. So we can probably look at the interactions of these block holders holding the same defendant firm and see if we can get some, variations cross-sectionally. Yeah, but so far we haven't. Yeah, so far we are assuming that this block holder holding Wall Street Journal and the defendant firm is an institution, and it's not, an industry firm like Amazon or Chipotle's competitors. Thank you.
Thank you.
All right, so this is the basic intuition of our story. So let me first highlight how we design our empirical test, and then we will go more into our data collection and variables and specifications. Okay, so essentially we're going to look at the litigation, which has a defendant firm. And we're going to look at two types of medium covering the same firm. One is the cross-held medium. So this is the medium that shares a common block holder with the defendant firm. And here I want to point out that when we're identifying this cross-holding status, we're using the ex-ante information. So that means that we're looking at this block holder's portfolio way before the litigation announcement. In other words, by the time that the litigation happens, this portfolio, this status is already preset. Okay, so now we're also going to look at the second type of medium that's non-cross-held. Okay, and our first difference is going to compare the tones, and I will talk a little bit more about how we measure the tone, the news tones from these two types of medium covering the same firm. Okay, that's the first difference. Now, the second difference is that we're going to track on the daily basis how this first difference changes before and after the litigation. Now, obviously, this empirical design has some advantages, and the first advantage is, straightforward. It's just from the definitive setting, which is to say that, the two types of medium may have different fundamentals, like their partisan or the size or the readership. But the second difference nets out such different fundamentals. Okay. Now, our second advantage comes from the daily event study. Because this daily frequency, we can essentially identify institutions' potential strategies that are triggered by these litigation events. And it's the same intuition as we're looking at the daily announcement returns of merger acquisitions in order to identify how that acquisition triggered the market reactions instead of the other way around, how the market triggers the acquisitions. So this is what we call the event study in a definitive setting. Okay. Now, let me talk a little bit more about how we implement this setting. Okay. So we get the corporate litigation from audit analytics. Okay, so this is the database that covers over 19,000 cases between 2007 and 2018, and that involves over 8,000 public firms as the lead defendants. Okay, now what's important in this database for us is that we observe the announcement date of each lawsuit, and this is important for our daily event study, as I just mentioned. And also we can observe the identity of the associate parties, including the defendant firms, so that we can merge this database to others to get their institutional ownership information. All right. So now, where do we get the news coverage? We get the news coverage from Ravenpack. And it is the database that includes all the news articles issued by major medium sources. And for the sake of the time, I do not have the table here, but we do have a table in the paper, that's table 1, that lists all the median sources that we include in our sample. And if you look at the table, you will see that Wall Street Journal, New York Times, and the Barron's are included there, okay? And then based on this, what we do is that we will link the defendant firm and the parent company of the median firm to 13F so that we will get the institution's ownership information. And based on that, then we say that an institution is the block holder for either the defendant firm or the median company if the institution holds at least 5% of the company's equity during the quarter before the litigation announcement. Okay, again, we're using the ex-ante information here. And you may be wondering why 5%, but we did robustness checks and we see we used alternative cutoffs like 4 or 6%, and our results are still the same. Okay. Now, lastly, after we define the block holder, we say that a median is the cross-held median if it shares a common block holder with the defendant firm, again, at the pre-litigation quarter. Okay. All right. So now the next variable that's very important for us is the median tone. Okay. So how do we measure that? All right. So if we think about what we need in this paper, all right. So the goal of our study is to look at if institutions can potentially manipulate the tone and ultimately influence the stock price that they hold. Okay. So in this case, what we need is the measure that captures not just the overall positivity or negativity of the tone, but we also need to know to what extent such sentiment affects the firm's stock price, because that's the ultimate goal. And for this reason, we're going to use a measure called the event sentiment score, which is also provided in Ravenpack. Okay, so now let me say a few words about this measure. All right, so this measure is a continuous measure between 0 and 100. Now, what's special about this measure is that in addition to just the saying this article is positive or negative, it embeds what they call an emotional factor, which can quantify the magnitude of these sentiments. For example, they look at the usage of words like critical, moderate, or inconsequential, okay? And they look at how heavily this article is using these words, and therefore it spans the basic type of the tone, positive or negative, to a full spectrum of sentiment. Okay, and that full spectrum is rated by experts in different areas, including finance and economics, to ultimately measure how that sentiment will affect the stock price. All right, so we're not the first to use this measure, and in fact, this measure can be seen in some other studies, and here is the partial list. All right. So before I go into our main results, let's see if we have any questions.
You're still good to go.
Okay. All right. So now here is the first picture showing you how the stock market reacts to the litigation. Okay. So this is the plot of the card of defendant firms around litigation. And on the x-axis, you will see the event days, and day 0 is the date when the litigation happens, when the litigation was announced. Okay. Now we plot this from 90 days before to 180 days after, and we use 2 different models. Now, not surprisingly, we see that starting from a few days before the announcement, we see a large drop in the stock price. Okay, and that drop and substantially lower the stock price, which is persistent for at least the next 180 days. Okay, now this is the evidence that tells us that investors care, especially for investors who hold a large position of the different firms, and that also justifies their potential incentives to pump up and to manipulate the median tone. And this is our main result. Okay. Now, what we show here is the following. This is essentially an event study in the DID setting. That's our main approach for this paper. And again, on the x-axis, we see event times. And on the y-axis, we see this ESS measure that captures the news tone. And a higher value of that measure means the tone is more favorable for the defendant, and the lower means it's more negative.
Han, Paul has a question for you.
Yes, Paul.
Yeah, I just want to point out, that's a massive event study reaction. Considering, is there some original work from back in the 80s that looked at this and got similar?
Yes, actually, we believe this is consistent with the previous study. So usually, they show up to 4 or 5 -% reaction in the market.
Okay, thank you.
Thank you. All right. So if we come back to this picture about the median tone, so we see 2 lines. One is non-cross-held median and one is cross-held median. Again, the blue line, the cross-held median, is the one where the median and the defendant firm share a common block holder. Okay. So there are several things that we see in the picture that I want to point out. The first thing is that before the litigation, during the normal times, we do not see evidence that the cross-held medium seems to be more friendly and doing any favor to the non-cross-held medium. To the defendant firm compared to the non-cross-held medium. Okay. Now, but this changes during the litigation period. Okay. There are 2 things that we see. First, the tone of the cross-held medium drops by only half as much as the non-cross-held medium. And second, the tone of the cross-held medium recovers more quickly after the litigation. Okay. Now, what this results combined is that there is probably about 60 days, or between 60 and 90 days, where the tone of the cross-held medium stays well above the non-cross-held medium. Okay. So later on, we will come back to this about 60-day period, and we will see what happens during this time on the defendant firm stock market price and also on institutions' trading strategies. Okay. And this picture is based on the daily news tones, the daily ESS. And we can also use the weekly ESS, which by definition is less noisy. And we see the same pattern, even though it's smoother. Yes, I think someone may have a question.
Yeah,
Paul?
Han,
Yeah.
Vikas had a question.
Yes, sorry.
He said, why does the tone of non-cross-held media bounce back so quickly?
Sorry. Well, this is part of the hypothesis we're trying to test. Well, the whole idea is that the cross-held media want to keep as positive as possible because of the cross-holding situation, and that's why they want to recover the job during the first few days of the litigation.
No, my question was more about I think sorry, just to follow up.
Okay.
I would have thought that the orange dotted line would probably persist for longer time after
for the
event.
non-cross-held media.
So my point was not about the green line, which I can understand your story, but what I was thinking is why does the non-cross-held media bounce back so quickly if they are not conflicted, right?
That's a good question. So my understanding, we have to look more into this, is that my understanding is that just like, overreaction in the stock market, there might be some sort of overreaction on the medium. Because remember, the whole point, all the media want to do is to catch the eyeballs of readers so that, they will gain readership. So in this case, they might, exaggerate a little bit the negative events during corporate litigation. So that's why we see that there is a sort of a reverse for both And that actually highlights the importance of why we need to compare the patterns of these two, because if there is this reversal patterns for all medians, we need to net that out. That's my understanding.
Thank you.
Thank you. Okay, all right, so now if we transform the two pictures into a regression setting, this is a very standard definitive setting where the variable of interest will be treat times post, where treat equals 1 if this is the cross-held median, but 0 if it's not, and post indicates this is after the litigation. I guess the only thing that I want to point out in this regression is that the rich data that we have allows us to include different layers of fixed effects and therefore isolate the variation in news tones from different perspectives. For example, we have over here, we have median by time fixed effect. So what it does is to absorb any time varying median characteristics. So in this case, we're really looking at the same median at the same time, but dealing with different defendant firms. Some of these firms share a blockholder with the median, but some does not. And we're comparing how the news tones vary across these situations. And we also have a median by event by the litigation event fixed effect, which is essentially the same as the median defendant firm pair fixed effect. So in that case, the news median tone, the news tone variation will come from, purely the time series before and after the litigation. Okay, so later on, we will come back to this setting. So we are aware that there might be some other, time varying characteristics that cannot be captured by these fixed effects. For example, people may say that, the cross-held median may happen to be less responsive in general. That characteristics will not be able to captured by the fixed effect. So we will come back to that and provide more tests. Okay.
Can I?
Yes, Tom, please.
Yeah, this is Tom.
Yes, hi.
Hi. My question is, why do we use the litigation as the event rather than the outbreak of the news? For example, in the case of Chipotle, the sickness of the being reported. I think in this series of events, maybe the sickness news itself or the event itself is a more significant information impact on the market instead of the litigation. People's attention typically in this kind of events probably are not focusing on for example, a class action lawsuits. Usually when these events happen, there are a series of, there are all these law firms, they are launching, perhaps a bunch of them launching lawsuits. We don't even know which one, is important, but the news itself that somebody got sick might be even more important.
Yeah, that's a good point. That's actually in our review, that's actually empirical question, because usually if we look at this part of the picture over here, the first part, and we see that somewhat decline already happening before 30 days, that's absolutely consistent with your intuition that maybe before the lawsuit, when the first, the first batch of news comes out to the market, investors are already thinking about this is going to lead somewhere. But the difference between the news and the litigation is that the litigation essentially confirms the concern from the market. And the litigation will lead to a verdict, and that verdict can be detrimental to the firm. So that is why empirically we see that the litigation itself triggers a much larger reaction than potentially the news itself. And that's why we focus on that litigation instead of the news itself, given that, if the institutions really want to do this pump and dump strategy, they probably want to make sure this negative event is going somewhere instead of, they putting into all this effort and for nothing.
Thanks. Yeah,
Thank you.
it makes sense. But another thing, perhaps confounding is, litigation typically is in reaction to a big price drop, because
Right.
in the litigation you have to prove materiality.
That's right.
So usually price already dropped by, for example, 5%. Then these law firms launch litigation. So it's actually consistent with the plot you have there. So before the zero, the price already dropped. Yeah.
Yes, I think you're absolutely right. So so this is again the weekly median tone picture. This is what we're looking at right now. So we do seem to find a little bit evidence that even before the announcement date of the litigation, the sort of more favorable median tone already shows up, which is consistent with your idea that investors are probably already noticing something, are taking some actions on this. And later on, I also have a picture to show you the sort of a trading strategies of those big investors. And there we will see again, their action seems to already start before this announcement date. And again, that shows investors' attention before, given before this litigation event.
Thanks.
Thank you.
Han, there's a question from Sugata. He asks, are there potential indigeneity concerns? For example, maybe litigation is more likely for media company cross-held block firms, or maybe media company block holders are more likely to own firms that have higher litigation risk. This would lead to other follow-on concerns in your empirical setting.
Okay, so I think the two concerns are different, and the first concern whether the defendant firms that are cross-held by the institution is more likely to get litigation. We don't believe that is the case because essentially litigation can happen to any firm, and there's no previous literature showing that litigation or the courts are especially targeting firms that share certain characteristics. But the second concern, whether the litigated firms are more likely to be held by the institutions, are possibly more likely. So there are several things that we do to address this concern. The first is that, like we said, the cross-holding status that we identify in this paper is considered preset. So we're using the information way before the litigation happens. So as long as that the institution cannot precisely predict which day the litigation announcement will be made, quarters before that actually happens, that addresses this indigeneity concern. And second, as our presentation goes on, we will also show you some cross-sectional results of what we have seen so far based on institutions' strategies and based on institutions' holdings stakes on either the medium part or the firm part. And we will show you there that the interpretation from those results are more consistent with the institutions reacting and then the media reacting to this event instead of any pre-arranged deals between the institution and the media, or the institution and the firms.
Han, Vikas has a follow-up question.
Yes.
Yeah, I think, Han, what I'm thinking is that maybe Tong was kind of pointing out to that, and Shugata's question is related. What I think might, I think maybe useful to show is that before the actual litigation, yeah, so in some sense, the probability of litigation might be related to the tone of the cross-held firms, cross-held media prior to the litigation. So can the cross-held media somehow reduce the chances that you would be litigated in the first place? So I see that, yeah, maybe litigation is somewhat exogenous, they cannot control it, but I think it would be nice if you can somehow show that, there's not much that the cross-held media can do prior to the actual litigation by changing their tone. Because, how they report the sickness, as Tong was saying, can actually also, trigger how much stock price will drop and how much how much noise is there in the media hue and cry. And so that's the part I think might be worthwhile.
That's a good idea. So I'm thinking about how we can potentially show it. Maybe we can compare two firms that experiences bad events, but one firm ends up with the litigation, the other does not, and see if that one firm that did not experience litigation is indeed cross-held by the medium. In other words, we can look at whether the outcome of litigation from bad news to litigation, whether that outcome can be predicted by cross-held medium, maybe something like that.
Or you can simply model whether litigation is in any way related to the differential in the tone between the cross-held and non-cross-held media prior to the event.
Yep. Yeah, we can definitely do that. Thank you.
You're right.
All right.
I have a question for you.
Yes.
I'm wondering, is there any, this is Kevin,
okay,
is there any data on where these stories are located in these newspapers and whatnot? Because it seems like that might be an interesting thing to look at as well. Are they on the front page? Are they, where are they featured in these sections? Is that something that you could possibly obtain?
So as far as I know, the Ravenpack database does not have the texts of the actual story. And also it does not have where the story shows up on a newspaper. So yeah, so I don't think we have that data.
Okay, thanks.
Okay. All right, so here is the regression results. So these are really straightforward results. So I would just go over them real quickly. And basically they are all consistent with the pictures that we have seen. Now, if we just look at the first panel A, which uses the daily median tone, and the second panel is essentially the same. And we see that the economic magnitude of these results are light up with what we saw in the picture. For example, if we look at the first column, and the post has a negative 0.59, which means that after the litigation, the non-treated group, which is the non-cross-held medium, dropped their tones by almost a 0.6, but that was mitigated if the median was the cross-held median, which can be seen by the red highlighted coefficient, which is almost the half of that. Okay, so now then we differentiate our main results based on the type of institutions. Now the idea is that most likely the pump and dump strategies will be observed for institutions that are most active instead of more passive, and this is indeed what we see. We're dividing the institutions based on two ways. And the first way is to look at whether they are activist institutions. In other words, whether they have 513D. And we see from the left side of the slides that indeed our results are mostly from the ones that file 13D and the ones that are most active. And on the right side, we're doing this in a slightly different way, but following the same intuition. We're looking at whether the institution, the cross-holding institution, are one of the big three funds that own the majority of the US index funds. So they include State Street, BlackRock, and Vanguard. Okay. Now we see again that our results are mostly coming from the ones that are not passive, that are non-index funds, non-big three. Okay, at the bottom of the right column. Okay. All right. So now, so far, we have seen evidence that the median tone seems to be inflated during the first 60 or 90 days after the litigation. So now we want to look at what's the price impact on this. Okay.
Quick question for you.
Yes, please.
Kelsey has a question. Says,
yes.
the index funds that need the pumping more because they cannot leave?
The index funds need to pump more because they cannot leave. That's an interesting, very interesting comment. Well, I don't have a good answer to that, and the only thing that I can think of is that I don't disagree with that. But on the other hand, I also think that these index funds probably are more passive, so they don't have the incentive to engage in such, sort of active actions. And then at the end of the day, I would think that's an empirical question. Maybe that's how we should phrase this in the paper. Instead of proposing this should be like this, we give out the two sides of the story and show it is more, in this case, the index funds are more passive and they don't do this. But thank you for that.
Han, Paul follows up on that and says that index funds might care less because they're not seeking alpha.
That's right. That's the other side of the story. So, okay. Index funds may care less. Yeah, so that's why they don't engage in this pump and dump. So yeah, so these two sides of the story we need to mention in the paper.
I guess Tom.
Yeah, Kelsey.
I guess the follow-up question is probably not much about the index funds, but about those like block holders who intend to stay longer.
Yes, you're absolutely right. So we actually later we will look at a test where we separate institutions that quickly exit versus the ones that actually stay longer. And we show that the ones that quickly exit are the ones who want to use this pumping the most. Yeah, I see your point now. So these two tests that we have kind of overlap with each other on the intuition. So we need to say this more clearly in the paper.
Han, Vikas has a follow-up for you as well.
Yes, Vikas.
So what I was thinking was that about the activist guys, they probably are trying to make some changes in the management. Is it clear that they want the stock price to bounce back, or they want to let it continue going down so that they can get their demands by saying, hey, you have to fix this problem?
So I should have said this before. So this is how we identify the activist institutions. So when we say that we look at the 13D filers, we didn't mean that we don't require this institution to target the defendant or the medium. So we're just looking at whether in the past 8 quarters, whether this institution has ever filed a 13D. Because here the purpose we're trying to do is to try to capture some sort of characteristics, instead of saying that this institution is trying to drag down the firm like you suggested. So to that extent, we shouldn't have that problem.
Thank you.
Thank you. All right, so here is the picture of the price impact of this pump and dump strategy, right? So what we see is the following in this picture. This is the picture of the CAR for the defendant firms from the date of announcement to 180 days later, okay? Now, the green line represents the defendant firms that are covered by at least one cross-held medium, which means that they are potentially subject to this pumping strategy, this tone manipulation. Okay. Now, as the comparison, as the benchmark, we also have this yellow line here that represents the firms that are not covered by any cross-held medium. Then, by definition, they will not be subject to them, or less subject to the medium tone manipulation. So, what do we see here? So, if we first look at this green line, we see that for the first about 90 days, the defendant stock price actually holds up quite well. Okay, it's almost a flat, and it is only after the 90 days it begins to drop. Okay, Now, this pattern is almost the opposite for the yellow line. And we see that for those ones that are not subject to the tone manipulation, their stock price drops straight into the first 90 days and then stabilizes. So now this is what we call this flat period for the green line is what we call the freeze out period. And this freeze out period stabilizes the stock price and therefore can provide the potential opportunity for the cross-holding institutions to unload gradually their positions on the defendant firm before the defendant firm stock price drops again. Okay.
Han, there's a question from Sugata.
Yes.
He says, is this just having a block holder being related to a slower sell-off process? Can you control for overall block holding levels?
So in this picture, we are not considering the block holding positions, but we are working on a more formal test of this to look at whether the more favorable median tone from cross-held medium are driving this different patterns in the stock price, and in there we can control for their block holdings. Okay, now again, so this freeze out period is something that the cross-holding institution can potentially take advantage of, and this is what we see. They are indeed doing that. Okay. Now, what do we see here? So this picture is essentially the changes in the defendant firm's position the changes in the institution's position on the defendant firm. Okay. Now, we don't have trading data for our institutions, so we're just using the changes in their holding positions to infirm what they have done to their positions. Again, there are two lines. The green line represents the cross-block holding institutions. So these are the guys that can potentially use this pump and dump strategy. And the yellow line is the one that are not block holding the medium and the defendant firm at the same time. Okay. So we normalize everyone's position on the defendant to 100% in the 1 quarter before the litigation quarter in the -1 quarter, so that you can review all these numbers as the changes relative to that pre-position. So what we see here is that starting from the quarter of litigation, and then it goes on for the next quarter, and then for the next 2 quarters, actually, the cross-holding institutions are more aggressively unloading their position on the defendant compared to the yellow line. And in fact, after 1 quarter, if we see quarter +1 over here, after 1 quarter, this cross-holding already unloaded almost 20% of their position on the defendant. Okay, so now if we can combine all these pictures together, so we say that for the first 60 to 90 days, there is more favorable tone from the medium, from the cross-held medium, and then we also see that during about the same period, and there's this freeze out period. This freeze out phase where the stock price holds up quite well, and again during the same period, we see the more aggressive unloading of these cross-holding institutions. So everything combined seems to suggest this de facto pump and dump strategy. Okay. So let's see if we have any questions before I move on to more tests.
So far, so good.
Okay, perfect. All right. So what I'm going to do for the rest of the presentation, I still have about 20 minutes. Perfect, is to add more flash to what we have seen so far. And the first consideration we have in mind is that, is this story really about institutions' strategies? Okay, now there is this concern that maybe the defendant firm and the medium were just talking to each other directly. They are the ones who are collaborating. And that's why we see the more favorable median tone to the defendant firm. But in that case, it has nothing to do with institutions, there's no strategic actions there. Okay, so here we're going to consider that that concern. So what we're going to do is the following. Now, if institutions' direct involvement and if their strategic actions on the pumping and dumping are important for our results, then we should see that both the pumping part and the dumping part driving our results. Okay, so we're going to falsify that. We're going to take out either the pumping part or the dumping part and see if indeed our results are weakened. Okay. Now, this is the first table where we strip out this strip out this dumping part. Okay. So what we do is that we talk about this a little bit earlier already. We look at separately two types of institutions. One type actually sells aggressively, actually dumps the defendant firm after the litigation, and the other one does not. Okay, so what we see here is that our results are stronger when the institution really want to dump the defendant firm, but almost insignificant in most cases if the institutions do not. Okay, so why is this important? Now, if we think about the information about dumping, so institutions dumping actions, here we're looking at the exposed dumping activities, right? So this information is sort of specific to the institutions. Okay, it is less likely to be known by either the medium or the defendant firm. Okay, now for this reason, when we see variations based on this type of activities, it tells us our story is more likely involving the direct communication, or at least the direct instructions from the institutions, instead of the medium and the defendant firm just talking directly to each other without the institutions doing anything.
Han, Kelsey has
yes.
a couple of comments.
Okay.
First, she says, I would actually expect the media pumping to be more pronounced among those cross-block holders who do not leave. And then she has a suggestion that maybe you can examine the outcome from the litigation.
Yes. Okay. So there are two things I would like to follow up on. We do have another test, which we won't be able to show today, that looks at dedicated investors versus more transit investors. And we find variations consistent with Kelsey's comments over there. But here, even though they sort of overlap with each other, but here we're more focused on the real actions and therefore their ex-ante incentives of pumping, okay, instead of a more sort of investment style as that alternative test. And second, we do look at litigation outcomes, and we have a test on that later, and that's probably for different context from what Kelsey is having in mind, but we can certainly circle back to that comment from Kelsey later when we're on that. All right, so this is the first table, and the second table is where we strip out the pumping part, right? So what we do is the following. We are going to look at a set of institutions that also block hold the medium firm, which means that they can influence the medium firm. But different from before, now they are just holding a small part of the defendant firm. Now, as other studies have shown, if the investor are just holding a small part, they are not subject to this illiquidity issue. So they don't need to go through this pumping and go through the pumping and dumping part. They can just quickly sell their small positions. In other words, in this case, we do not have strong pumping incentives for the institutions. And indeed, here we don't see much going on when there's no pumping incentives. So what these two tables combines tells us that both the pumping and the dumping are important for our results. And therefore, it's not likely, our results are not likely explained by the alternative argument that the medium firm and the defendant firm are just talking with each other without the involvement of institutions.
Han, Vikas has a question for you.
Yes, please.
Yeah, and so The cross-sectional tests that you have done are essentially looking at it from the firm's point of view, how much position they have in the firm. But it might also be interesting to see how important is that firm in the institution's portfolio. Did you look at that?
The
Like, so
firm in the, I see. Yeah. Um,
because if it's a larger part of my portfolio, right, clearly I care about it more, right?
that's right. That's right. Yes, we can certainly look at that. Let me think about this second test. I think this second test is essential. Oh yeah, I see. Yes, I see. So we're only looking at the 5% cutoff, but essentially you're suggesting we're looking at the stake. How
Yeah,
much stake? How
I'm
much
looking
stake
at
in
the weight of that firm in
Mhm.
in the institution's portfolio, right? So
Yeah.
it's from the institution's perspective.
Mhm. Right. That's definitely something that we can look at. Thank you.
Thank you.
Okay. Now, the second consideration that we are thinking about is um, something related to I said earlier when I talk about the fixed effects. That is, maybe there is some time varying characteristics that cannot be absorbed by the fixed effect. And you may argue that some media may just be more conservative and they are irresponsive to any type of news. Okay. Now, in this case, the medium will respond less negatively to the corporate litigation, resulting in a smaller drop in the news tone, which is what we observe. And if by any chance such medium is also cross-held by the institutions, then that's an alternative explanation for our paper. Okay, so how do we address this concern? We're going to look at the resolution of the corporation, the resolution of the litigation, as Kelsey was just bringing up. So what we do is the following. A lot of the times, the resolution of the lawsuits can be more positive than expected. And this could be because the verdict is not as detrimental to the firm or the lawsuit was dismissed. And in fact, we see in our sample about half our litigation have a positive CAR during the few days surrounding the resolution. Okay, so these events provides us an opportunity to see how the medium will react to positive litigation news. And by definition, because this is positive litigation news, there shouldn't be any pump and dump incentives. Okay, so now if the cross-held medium are just happen to be irresponsive to any news, then we should observe their tongue pop up less during those positive events compared to the non-cross-held medium. Okay, now this is what we find here. We don't see anything. Okay, the cross-held medium in the face of positive news is reacting as positively as the non-cross-held medium, which means that the more conservative or irresponsive concern should not hold in our story. Okay, so the last set of tests that we're looking at is based on is sort of an extensive margin test. Okay, so here we're asking the question: does this pump and dump incentive change the volume of the medium coverage to start with? Okay, you can argue either way. You can say that in order to avoid saying bad things about the different firms, the cross-held medium issue fewer articles. So that's what we call the strategic silence. Or you can argue the other way. In order to help the different firms, they actually want to become the cheerleaders and they want to say more about the different firm. We take that as an empirical question, and now we change the dependent variable of our regressions to the number of articles. And we find that it's more of a strategic silence story. Okay, so if we combine this extensive margin results with the intensive margin based on the tone that we showed before, we see that this incentives first makes the cross-held medium issue fewer articles, and then conditional on the fewer articles, their tone is more positive, which means that information released by this cross-held medium is kind of biased. Okay. All right, so now lastly, we have several supplementary tests in the paper. And for the interest of the time, I think I will just go run through them really quickly. Okay. First of all, we look at two different strategies from the institution. In order to pump up investor sentiment, they can either play down this current litigation event, or they can play up other unrelated matters but positive matters in order to cheer up shareholders. And we look at these two different cases. We find that the playing down the current litigation is a more prominent strategy, but it's not exclusive. The other part, the playing up non-legal matters, also play a role in our story. Okay. Now, second, we also differently look at whether the article is based on soft information or hard information. Hard information, including the Medium article, the Medium articles talking about analyst recommendations or credit ratings or their earnings, and we find that this pumping action is more concentrated on the soft information, which is intuitive. Okay. Now, next, we also look at local versus national medium, and we find that the strategy is more pronounced for local medium, which again makes sense because there's more room to manipulate those relatively smaller medium. And lastly, we look at the uncertainty about the litigation. The more uncertainty there is, the more room there is to shape investors' views by issuing positive articles. And this is indeed what we find. The pumping strategy is stronger for litigations that involve high uncertainty. Okay. Okay, now this actually leads me to conclude. So I would like to conclude what we find by positioning this paper in the existing literature. First, there are existing literature existing papers documenting firms manage the timing and the content of the press release. And we believe that we're the first to show that the media can be strategically distorted through cross ownership. And here in our story, the motive for the institutions to do that is to prevent losses from their troubled investment instead of firms' self-promotion motive. Okay. And second, this first conclusion then leads to a sort of interesting contrast to the existing literature, because many studies have shown that institutional investors may promote information production and improve the stock market efficiency, but we show a potential downside depending on their the structure of their portfolio. They might want to sacrifice information content for their trading profit. Okay. All right, I will be very happy to take any more questions, if any.
Thank you, Han. I'll leave the room open here for a while, so
Okay,
we can
perfect.
continue the discussion. So thank you for everybody attending, and the floor is open for anybody who wants to ask questions to Han.
Yes, thank you so much. And then for those who are leaving, let me just say on behalf of my two co-authors, thank you so much for your comments, and I look forward to seeing you in person sometime soon.